everyone. Welcome or welcome back to your favorite show, The Lens, hosted by Craig Shapiro and Larry McDonald. This week we have amazing updates for you. Larry is back home finally after a few weeks of traveling, visiting clients, meeting new people. Guess what, guys? We're back on the top 10 on Amazon. Get How to Listen Where Markets Speak Now. You can find them on the link below. Guys, go ahead.
Thank you, Valentina. Yeah, it's been an exciting week. It's nice to have the book back up there and the reach number 2 this week. And at the end of the day, Craig's been talking about this for like 6 months. And Craig, you know what? This like evidence of stagflation, and you've been predicting this, and we talk about it in the book. And it's like every single kind of like not every week, but almost every week in the last 3, 4 weeks, there's more and more evidence of either an inflation bounce or slower growth. And that slower growth is what they need really for rate cuts. And everybody's kind of like, okay, it feels like the street is in this like Goldilocks world where they want slower growth for the rate cuts, but they're also saying that earnings growth is going to be I think 10% over the next year.
Yeah.
How does that work out, Craig?
Yeah. Look, I think people, or at least the market, is pricing in or is desiring this immaculate disinflation, right? Which is the prices are slowing, disinflationary trends are constructive, and that's going to give the Fed carte blanche to engage in a fairly aggressive rate cutting cycle into an economy that they believe is fine, in a labor market that is fine, and that's going to lead to continued high corporate profits and accelerating earnings growth momentum into 2026. I think that is the hope. That is what's being priced into markets here at all-time highs on equities, and with multiple rate cuts priced in for this year and a cutting cycle for
So
next year.
where do we move from for rate cuts in the last 10 days?
So we've bounced a bit back and forth, right? I mean, kind of into the or right on the back of the CPI print, we moved into some expectations. Well, we had 100% expectation of a September rate cut, and some people, including the Treasury Secretary, saying maybe we could get a 50 basis point rate cut in September because the labor market has been so weak that the Fed should have been cutting as early as June if these labor market data is to believe. And then,
And if they look at freight, if they look at the freight data on the chart here, I mean, that's going to scare the hell out of the White House, right? And for rate cuts.
Yeah, look, I think there's this. Well, we've talked about this bifurcated economy, right? There's the wealthy and the cash rich companies and the large cap companies, and anybody tied into the AI value chain and infrastructure build out has been doing incredibly well. And anybody at the lower part of the K-shaped economy, low end consumer, small business, air freight, things that are tied into consumption and retail, and housing and tariffs are just getting screwed. And so I think what the administration would like to do is they'd like to cut rates so that lower part of the K-shaped economy starts to do better. The problem is the cutting of rates before inflation has been really slayed means that the upper part of the K-shaped economy keeps gunning it, right? And keeps seeing higher wealth gains and stronger asset price momentum, and ultimately makes it more difficult for inflation to actually be slayed. And so I think that the Fed is dealing with this dichotomy as well. And so you have the newly anointed doves on the Fed, the Wallers and the Bowmans of the world, who used to be hawks but now are aggressive doves who want rate cuts because they say inflation, tariff inflation is transitory, are being balanced by some of the more hawkish members who are thinking, look, wealth effects are still very strong. Services inflation is running well above what we would expect necessary to bring inflation back down to target. And so we don't want to engage in that aggressive rate cutting cycle as of yet. And now we obviously know how political this Fed process has become, and the administration is blasting the Fed every day. And so, look, I think the market is pricing in the political whims winning out, right, over the data. The data right now would suggest the Fed should probably cut, but go slow. Whereas the administration wants the Fed to have already started cutting, cut more aggressively, and go fast. And I think the market believes that the political whims will win out, which is why markets are at the highs as we speak. So it's a bit of a weird dichotomy.
So Craig, you're running the Discord room, and we have the Bloomberg chat behind me. But this chart here, what a lot of institutional investors now, we have hundreds and hundreds of institutional investors in more than 20 countries, but we've got great contributors. Let's just say you were at Appaloosa for 20 years, and now you're running the family money in Palm Beach, or you were with, say you were More Capital. Some of these great institutional companies, hedge funds, a lot of their talent is now kind of running family money around. There are great contributors in the chat. And one of the things that we're talking about this week with some of the contributors is this breakdown in leadership, Craig, whether it be NVIDIA, whether it be PLTR, Walmart, all the charts kind of look the same. This thing, everything that led the market the last 60 days is kind of like, you have these kind of charts with a breakdown here.
Yeah. Look, I think the question is whether or not the market breadth is going to accelerate from here, get better, or is it going to deteriorate? And right, I think what we've seen over the course of the last several weeks is we've seen massive volatility suppression, right, across the board. Bond volatility suppression, cross asset volatility suppression, and certainly equity volatility suppression. And what that's meant is systematic releveraging of equities and portfolios. And as the S&P kind of grinds up methodically, the laggard sectors, the meme stocks, the most shorted stocks, the small caps, the cyclicals, have really started to outperform. And the question is that solely because of this vol suppression, and because the economy is probably fine and getting better into a rate cutting cycle? Or are we at the point now where the reality is, look, the vol suppression has come all the way back. We've gotten to the lows again. Seasonally, we've gotten to the lows, and even just mathematically, we're kind of getting back very much to the lows. And so as the data starts to slow down, we see this roll back over again. And so the rotation into, I'd say, lack of quality or crap stocks or short stocks actually starts to peter out, and the rotation goes into defenses because we're more worried about economic momentum. I think we're at that critical juncture right now. I know you have the Walmart chart up there. They report next week. NVIDIA reports the week after. So we're going to get a lot of information now. And even the macro data that comes out for this month, that comes in the early part of September, we'll get a good read on whether or not this rally in the S&P 490, for lack of a better word, can continue, or was this just a short covering squeeze that rolls back over into a slowing economy that the Fed will be late to address?
Yeah, and but I want to correct you there a little bit, Craig. So the way I look at it, and what I'm, been on the road. We did the Ideas Dinner in San Francisco, did the Ideas Dinner in LA, and I was in New York last week. What I'm hearing is that, first of all, tertiary versus established assets. So things like meme stocks versus Qs, or things like most shorted stocks, which are kind of like leveraged, banged up companies. Most shorted, the most all that stuff, right, was leading for like 90 days or 75 days, was leading the market. And now the last like week or two, you've had a rollover, a move back up, but at a lower level. In other words, I think the momentum stuff that a lot of like professional investors look at on the West Coast, like real hedge funds, they look at like this. They look at each one of the verticals of tertiary versus established. They look at Solana versus Bitcoin. They look at jobby aviation type companies, jobby $14-15 billion market cap, no sales, right? So that's another vertical. And all of these verticals are starting to break down since like the last like 10 days or so. You're right. You had a move down, move back up, and then starting the last couple of days, move back down again. And they're not taking out the highs. Leadership like Capital One, we're seeing tertiary financials underperforming Capital One, the credit acceptance, the alleys of the world. Seeing a big move down today in SLM. So you're seeing some big move in the financial. SLM, I think, is down 9%. Sam, Larry, Mary. What are people saying there?
Yeah, look, I think it's these these financials are typically in the crosshairs at these inflection points, right? I mean, you basically wind up having the most shorted names or the most speculative names kind of, they've caught up. they've done incredibly well. And then the question is it sustainable? Can it keep going? Is the economic momentum really there? Are the rate cuts that are being priced in actually going to improve the economic outlook for the most levered financial companies? And so I think that's the battle that we've been facing and kind of dealing with here. Delinquencies at Sallie Mae are rising, right? And so that not surprisingly, given the college loan forbearance elimination that took place, delinquencies are going up, right? Consumer wallet share at the low end is being incredibly strained. And so it shouldn't be surprising that Sallie Mae is down 10% on numbers and on delinquencies, and so, or July delinquencies, which is what's hitting the stock today. So again, I think we're at this critical point where the garbage has rallied. We kind of got to expiry in August. We're here, and then from here, what's the economic reality? Is the economic reality such that delinquencies keep rising for the low end consumer, which I think is going to take down all these financials, or rate cuts are going to be enough? And we're going to just be smooth sailing here into the back of the year. I think where my head's at. It's for the rollover. But I think I would have said that 2 weeks ago or 3 weeks ago, and we had another move higher in all of this stuff because volatility has continued to be sold. But I think we've arrived now at that point, certainly seasonally and on an absolute level, where hard to get vol continuing to accelerate to the downside here.
We don't have a chart, but I'll tell you one thing. The last year, anybody that bought vol here has made money. Literally, every time you've bought down, you've been long volatility here, you've made money as long as you exited at the right time, right? But we've bounced off of this level a lot of times. Craig, another big conversation point. Everybody knows United Health is up a lot today, and this chart doesn't do it justice, but there is a small rotation out of tech into healthcare that people are talking about today.
Yeah, look, this is the rotation question I think is on everybody's mind, right? Everyone's had this AI outperformance trade, this big tech trade, this huge trade, and so from here, as we started to see some initial signs of chinks in the armor on the story, right? CoreWeave got hit, Cisco got hit, AMAT got hit. So there's some questions now at parts of the value chain in the AI build out that investors are asking. So they're thinking, okay, I'm going to rotate some of my capital. These have been great stocks. Where am I going to put it? Am I going to put it into cyclicals and housing and small caps and things that benefit from the economy improving from here with rate cuts? Or am I going to put it into defensives, which will benefit from rate cuts coming and the economy slowing? And so I think this idea here where healthcare is starting to relatively outperform tech kind of shows you how people are starting to move some capital into the more defensive areas. I think the United Health thing being bombed out like it is, and people have been trying to call a bottom there, and then Buffett comes in and announces that he's been buying it too, I think it's given some life to to some of these. But I think it's also this idea they're defensive. And the other thing too is utilities used to be a defensive sector, but now that utilities are very much tied into the AI story, they've become less of a defensive sector that are going to benefit from rate cuts. So more capital kind of moving into true defensives like healthcare and maybe staples, I think are going to be on top of mind for folks. And I think as the data continues to slow, you'll see more of that rotation in the coming months.
Craig, thank you for that, Craig. Another thing that's really important from the week. So what we try to do in the lens here is talk about what are the institutional investors talking about around the world. Craig, you're running the Discord room. If someone's coming off an airplane and been in a long meeting, get in the room with Craig. Get your portfolio focused, right? And so I find it fascinating because in the old days, Steve Seifel and I used to trade converts and been in the convert market for 30 years. But CFOs, Craig, they're the best sellers in the world. Like, who's a better seller of their own stock than a CFO, right? And so I thought it was interesting. We've taken a big position in the uranium names, NUKZ, URNM, Cameco, last multiple years. And especially in April and May, really pounding the table, getting the clients to invest in energy infrastructure through the NUKZ type portfolio. And guess what? A number of convert issuers in the nuclear, I should say, the uranium space this week. So that we've been taking some money off the table. When you see CFOs come in with aggressive sales of convertible bonds, they're selling upside stock. They're a better seller than you, ladies and gentlemen. And I also find it interesting. Circles doing this wacky secondary after they do an IPO, and then like in June, and now they're doing a secondary with the insiders puking out the stock. Basically telling it to the street it's yours, and then you get another convert out of the serial issuer Coinbase, another convert now. And
Yeah.
if you look back, one of the things people talk about when Coinbase doesn't convert, look at the performance in the crypto space, like within the next 6 months after. They're very good sellers of equity.
Yeah, I mean, some of these IPOs, like this Firefly Aerospace was an IPO that was a hot sell. It's been down basically every day. And look, this is what happens when you have markets that are stretched and have done well for a while. Is the supply of stock hits the market, right? Everybody talks about share buybacks as being this negative part of the supply story for equities and driving up valuations, but there is another part of that: supply additions, right? IPOs, secondaries, converts. And so after a big run, you're seeing sold to you, right? Insiders are selling. Private companies that are seeing huge valuation uplifts are starting to say, let me monetize a little bit here. This is what happens. Now, look, it doesn't mean the market's going to crash tomorrow, but this is what you'd like. This is what you
Right.
see when markets have run, is supply story. It's like a commodity, right? When prices are up, producers go, they produce more, they supply the market with more. Here we have equity markets are up, and companies are supplying stock to the market and look, as a long-term investor in some of these companies, you want the company to go out and say, I will sell my overvalued equity to raise cash, which is what many of these companies are doing. Not all of them. Some of them are just raising money for insiders, and that did distinguish. But for some of these uranium names, they're selling upside calls in equity to raise cash to build out capacity for the AI boom, right? So you don't want to get in today, but this is going to make those stories longer term sustainable, right? Now they have 5 years of cash sitting in the balance sheet to go and build out the power plant or build out the nuclear mine or the uranium mine. And so that's what you want as a long-term holder. But if you're a short-term trader and you get stuffed with a convert on that day, you're
Right.
a little bit of pain. That's kind of where we are with some of those names.
Craig, who can forget Bill Wang and Archie Ghost in 2021, right? This guy made $1 billion in like a very short period of time. He had whole street offsides. I think he's heading to prison now. But people forget I think it was a convert or a secondary on one or two of his big positions, and this was size. So basically, he was juicing the market just like a lot of people are today. The Momo crowd juicing, and they're using leverage and leverage on leverage. And then, sure enough, one or two companies came out and issued a mammoth secondary convert in his face, and that is what picked that. It was part of the top in 21. It was before the top in 21 was really in the fourth quarter, but it was, like you said, it's not today, but it's a sign that you're near some inflection point when you see those converts and those secondaries. But Craig, have a great weekend. If there's anything else important, please let us know. But we're up at 18 minutes, and thanks, Valentina. Thanks for the team in New York, and it's nice to be back home after being on the road too long.
Yeah, no, it's been good. And hopefully, your area, my area, stay away from hurricane season. It'll be nice. And but two more weeks of August, and then we get back to it after Labor Day. We're going to be right into it, the Fed meetings and the data, and so a lot coming up. But probably still a little bit quiet here for the next couple of weeks as people are finishing up their summer vacations.
One of a CIO from London made a comment in the chat today. It was really funny. It's like Trump's talking about this meeting with Putin and high stakes and everything, and the VIX is making
new lows, making new lows for the year.
Multiple new lows. But nobody cares. And but hey, have a great weekend, and we'll talk to everybody next week.
Sounds good. Take care, Larry.
Many thanks, guys. Many thanks, everybody, for joining us. Remember, if you're interested in joining our Bloomberg Live chat, our Discord chat, if you're interested in getting the one idea, our turning point, remember you can reach out to info@thebirdshopsreport.com, and I'll be happy to assist you. Then again, don't forget you get your copy, How to Listen When Markets Speak. Thank you so much for joining us, and we'll see you next week. Bye.